Hello everybody. So as most Sundays, I offer a very short video, very busy on Sundays. But anyways, I want to talk about dot day. Of course, we have dot day, and I want to talk about the return of capital dividend, MSTR, ROC dividends. I want to talk about that because that's trending today. A lot of people are talking about those, kind of starting to realize what Saylor means by that. So let's talk about this. So of course, he bought more last week. I expect a small buy. Stretch is not trading above 100. I don't think he ATM'd, so a small buy, a few hundred Bitcoin, that's what we can expect, I think. Talking about Bitcoin itself, it has felt like a stable coin for 23 days. Volatility has been low. I mean, we went as low as 105, as high as 115. And we're at 110. So that's a volatility less than 5% or something like that. The volatility over 23 days has been very, very low for Bitcoin. So, of course, there's not a lot of vitality in the market. People are bored, essentially, since that tweet about China. We never really recovered. And I think a lot of people may have left the market after the 19 billion in liquidations that we had on that awful Friday night of early October. But anyways, yeah, the crypto fear is very high at 35. But, you know, will November change that? As some people call it, Moonvember. Are we actually going to get that? Hoping so, really hoping so. But it doesn't matter if you're a long-term investor. If you don't have options, it doesn't matter. You have time to wait. You have time to wait and to just sit there and relax and do something else. I do want to highlight, of course, Scott Bessent, right, the CFO of the United States, tweeting about the Bitcoin paper. This is pretty surreal. This is the most. I mean, this is besides the chair of the Fed. This is the other super important person in the U.S. financial system. You know, Treasury Secretary of the United States tweeting about Bitcoin. I mean, that's surreal. You have a president of the United States who says, "Don't sell your Bitcoin," and then you have the Secretary Treasury who tweets about the birthday of the Bitcoin white paper. And you know, in a few months, we might hear about a new Fed chair. What if a new Fed chair is pro-Bitcoin? Think about that. You would have the three most powerful people who are pro-Bitcoin. So this is a meaningful tweet, I think, from Scott Bessent, and that's why Saylor retweeted. Okay, let's move on and talk about return of capital. I talked about it before. So, of course, return of capital, this is something that you may have been familiar with if you ever owned, say, either a pipeline or some REITs. Some REITs and some pipeline issue these return of capital dividends, but they're not as common as qualified dividend, right? The most common dividend you can get is a qualified dividend, which is, for most people, taxed at 15%. If you're in the highest tax bracket, taxed at 20%. And then some states have very bad state tax on top of that. That's why Saylor says qualified dividend could be charged up to 35%. Interest income is even worse. Ordinary income plus state tax. So it could be 37 to 55%. And return of capital are, of course, taxed at 0% for the first 10 years. For the first 10 years until you actually start paying taxes. And so that's the beauty of this presentation here that Saylor puts. You know, assuming a 10% yield at par on a $100 instrument. So 10% each year at par on a $100 instrument. That means you would only start paying taxes in year 11 when your cost basis is 0, right? Because 10% times 10, that's 100%. Your cost base is gone, and then you start paying taxes. And then he assumes you get a 10% ROC dividend, 10% ROC dividend for 10 years, and you reinvest it every quarter tax-free. And so this is your return. If you have 10% in a taxable treated as income, what would it be? It would be, we have 37 tax rate, 37% tax rate. So over 10 years, you would turn 100 into 187. 100 into 187. I mean, that's pretty much like a lot of investments, like, you know, well, real estate, you can get it right off. But let's assume like a straight bond, like a junk bond, who would pay 10%. And let's assume you are a successful individual, you're already in the highest tax bracket. Well, you would essentially not even double your investment in 10 years, you would turn 100 into 187. Now, if it was a qualified dividend, it'd be a little bit better. Qualified dividend, you would more than double your investment from $100 to $221. So that'd be 18% more than the worst case scenario, which is the highest tax. And in the case of a ROC dividend, in the case of a strategy instrument, you would turn 100 into 269 by taking that 10% yield, reinvesting it quarterly for 10 years. You would get 269. You would turn 100 into 269, and only on year 11 would you start paying paying taxes. You would start paying taxes on those payments, and you would start paying taxes at the qualified dividend rate of 20%, again, assuming that you make more than 500 and something thousand a year, assuming that. Otherwise, it's 15%. So most people think qualified dividends are going to be 15%, but it could be more if you're in the highest tax bracket. And so that's the power of this return of capital dividends. And so when you take this example and you actually convert it into a highest taxed equivalent yield, this is the yield that you would need to get in order to obtain an equivalent return to the MSTR preferred if they were taxed like interest income is normally taxed, if they were taxed at the 37% tax bracket of people making more than 500 grand a year. And this is where it gets very, very, very powerful. In other words, the richest you are, the more compelling these instruments get, the richest you are. And that's, 14% for Strife, 16% for Stretch, 20% for Stride. That's the equivalent. That's the return equivalent you would need to get. And then 21% for Strike. Strike is the highest yielding instrument. Why is it 21% for Strike? Because he removes the call option. When he calculates the return on Strike, we know it's an 8% yield on $100 par, but he removes the price of a call option, which is 10% of the MSTR stock. So actually, if you're going to have an $80 strike, you're going to remove, I guess right now, $28, which is the equity portion of Strike. You're going to remove that, and then you're going to calculate the yield of the $50 and change, yielding 8%, and then you add the 37% of tax you would have paid, and you get to 21, nearly 22% tax equivalent. That's why I've always said Strike is kind of my preferred. It's the preferred that I like the most, even though I got to this conclusion for another method. But the way to get to this is really to think about the fact that it's ROC dividend means that the proper comparison of the preferred is pretty much junk bond instruments that really do not exist out there. And of course, another implication of this is pretty obvious, but another implication of this is that you don't want to own any of these in a Roth IRA, for example, or in a tax-deferred account. These are the instruments to put in a taxable account because of how great this return of capital qualification is. So anyways, for now, we can benefit from it. For now, this is amazing. Who knows if this gets too big, my guess is at some point the tax code will catch up to that and modify something if this were to ever get too big. But otherwise, this really does seem really, really good. This seems really, really good. And Fong finished saying in the call, of course, he said that whatever they do, whatever fundraising strategy, their goal is to maintain the return of capital qualification. So expect more of promotion of return of capital from them. Very interesting stuff, if you ask me. Bitcoin needs to rebound. Hopefully we'd get that sometime in November. Anyways, this was not investment advice, not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.